Hello everyone. What if I told you there is a section in the IRS tax code, and I mean it's right there in black and white, that lets you rent your personal home to your business, collect that rental income completely tax-free, and your practice deducts it as a business expense. It exists, and very rare when dentists are actually using this deduction. And I'm not talking about the home office deduction. My name is Natalia. I'm certified tax coach and certified tax planner, and I run Custom Accounting CPA. We work specifically with dental practice owners, practices doing between 1 to 5 million in gross sales, and who paying more in taxes than they should be. And this episode is 2 out of 12-part series, and today we are talking about the Augusta Rule, how to pay yourself tax-free money from your practice legally. If you're just joining me, drop a hello in the comments with where you're tuning in from. And if you have a friend or colleague who owns a dental practice, tag them right now. This one is going to be worth their time. Here is the reality. Dentists are constantly hunting for deductions, new equipment, marketing spend, CE courses, and often missing one that's sitting inside their own home. Your accountant files your return once a year and moves on to the next client. They're not sitting down in July thinking about what's happening inside your four walls that you could be getting paid for. And that's not a knock on them. Compliance work and strategy work are just different jobs. But it means strategies like this one sit unused for years and nobody ever brings it up. Section 280AG of the tax code, commonly called the Augusta Rule, lets you rent your personal residence to your business for up to 14 days per year. The rental income you receive is completely excluded from your personal taxable income. Your business deducts it as a legitimate business expense. This isn't a gray area loophole. It's a real, specifically written provision in the tax code. One important qualifier. This works when your practice is structured as an S Corp or C Corp. If you're a sole proprietor and you're taxed as a disregarded entity on Schedule C, you cannot rent to yourself. There is no separate taxpayer on the other side of that transaction. So this is one more reason entity structure, which we covered last week, is the foundation everything else sits on. So how it works in practice? Your S Corp or C Corp holds a board meeting, a strategy session, or a team planning day at your home. You charge your business the fair market rental rate for that space, which you document using comparable rates for similar meeting space in your area. Here is what this actually looks like. Say your practice nets $700,000 a year and you are taxed as an S Corp. You hold 4 planning meetings a year with your office manager and lead hygiene, reviewing production numbers, staffing, marketing calendar, plus your annual strategic planning day and a couple of team appreciation events. That's 8 days per year. You pull 3 comparable rates for event or meeting space in your area. Say a boutique event venue or hotel meeting room and a private dining space, and they average $2.2 thousand a day. Your practice pays you, multiplied by 8, $17,600 for the year, signed agenda, sign-in sheets, and the comparable listings saved in your file. This $17,600 is fully deductible to your practice and complete tax free to you personally. At 35% combined tax rate, that's roughly $6,160 you would have paid in tax on that same money if it had come to you as a salary or distribution instead. If you push it to the full 14 allowable days per year at that same rate of $2,200 average, and you are at $30,800 tax, which translates to about $10,780 in taxes you simply never pay. And this is every single year. So very important to remember. Documentation for this strategy is everything. Very important. You need meeting agenda, attendance records, minutes, and market rate comparable that actually reflect the kind of space you are renting, not a hotel ballroom rate for your living room. The meeting needs a genuine business purpose. It cannot be just a rubber stamp to move money. The IRS has pushed back on Augusta Rule arrangements before, and the ones that survive scrutiny are the ones with real documentation behind them. Do this right, and it's bulletproof. Do the sloppy, and you are created an audit target. Now, here is what I want you to do with this information. If you want the exact template we use with clients, the agenda format, the documentation checklist, the rate setting formula, as well as website where you can check the comparable rates to rent your space, message me the word Augusta and I will send it to you directly. And you will be able to implement the strategy by yourself, knowing that your documentation is bulletproof and will withhold the audit. So next week, we will talk about retirement accounts. Specifically, we will why the standard 401k advice that your financial advisor gave you is probably leaving $100,000 in tax deduction on the table every year. If today gave you one thing to think about, one moment where you thought, I should look into this, then it was worth 10 minutes of your time. Share this video and tag a colleague. And I will see you next week, same time, right here. And remember, you deserve to keep more of what you earn. With proactive tax planning, it's possible.